AI Finance Daily, where artificial intelligence meets your money. We need to talk about OpenAI's valuation makes no sense. And here's what a real DCF says it's worth. Now it's easy to see how the hype builds. We have ChatGPT producing human-like text, generating everything from grocery lists to the next great American novel. But here's the kicker. The rational approach, the classic discounted cash flow model, essentially an economic diet plan for valuing companies, may completely misjudge this scenario. Most analysts will tell you to project revenues and costs into the future, then discount them back to their present value. Clean and neat, right? However, there's a catch. The assumptions you make have the power to turn that $90 billion valuation into a mirage. Here's a little reality check. OpenAI reported a revenue of about $1 billion in 2023. If we assume this growth continues at, say, 30% annually, a reasonable growth rate considering the buzz, we're looking at projected revenues of roughly $4 billion by 2028. Now, let's apply our standard DCF formula, and we quickly find that this might suggest a value in the range of $30–40 billion. But hold on. This isn't a straight road. It's a roller coaster. Costs could rise. Competition is heating up. Google is investing like there's no tomorrow. And Microsoft's spending is practically reckless with billions pumped into AI technologies. Analysts suggest these expenses could limit margins, which is a polite way of saying profits might not keep pace with the inflated expectations. So who really benefits from this inflated valuation? Well, take a look at the venture capitalists who backed OpenAI. They may very well be the hidden winners in this narrative. They've invested early, holding stakes that will pay off even if the public markets have gone a bit too wild. Let's swing back to the personal stakes. What does this mean for your money, your investments, or your startup? If you're an investor or entrepreneur, understanding the gap between hype and realistic expectations could be the difference between funding the next revolutionary tool and being trapped in an echo chamber of inflated valuations. Let's frame this differently. A typical investor might look at OpenAI and think, 80% growth potential? I'm on board. But one scenario is that instead of radical growth, we see a plateau as competition saturates the market. The belief is seductive. We love innovation. We yearn for the next big thing. But remember, in finance, illusions can be expensive. Now let's touch on the limits of this argument. There's always the prospect of unforeseen breakthroughs, a new product that disrupts everything. Maybe OpenAI introduces something revolutionary that catapults them into an entirely new stratosphere. One of the biggest benefits of this technology might be the intangible factors that no one included in their pitch decks. To counter this contrarian view, what would need to change my mind? Well, transparent operational metrics from OpenAI would help. A clearer demonstration of sustainable profits would turn heads. If by 2025 they show positive cash flow and a manageable expense structure while still scaling, that valuation of $90 billion could start to sound reasonable. In conclusion, think critically around these large valuations. Remember, the consensus can often misprice the potential risks hiding behind unreasonably high valuations. But there's opportunity in these discrepancies. It's fair game for an informed investor willing to analyze beyond the hype. The figures discussed here are drawn from publicly available data. Always verify before making any financial decision. This is educational content, not financial advice. That wraps up AI Finance Daily. One small ask. If this was useful, hit follow. It costs you nothing, and it means we can keep making this. See you next time. Next.